Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did. Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How are you doing this morning? Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome. You're going to hear stuff here that you don't hear anywhere else on radio.
And you don't forget it.
I'm Jeffrey Shank, and this is Talk Money. I'm a chartered financial consultant. I'm the owner of Andover Advisory Group, a registered investment advisor, and for almost 30 years, I have provided effective financial advice for individuals and small businesses. My mission here on Talk Money is to help improve your money IQ. One of the areas that we like to educate you on is taxes. So we're going to talk about a particular part of the tax code, a new addition to the tax code, the no tax on overtime today. Good morning, Lou. How are you?
Doing very well.
Hey, can we do the commercial first today? Would that be a problem?
Do the commercial first?
Yeah.
Why?
Because I'm really excited about this do-it-yourself tax preparation solution that we've discovered, and so I wanted to kind of put up the QR code, tell people about it.
Oh, yeah.
Before we get into the no tax on
Didn't
overtime.
know where you were going. Yeah, I can do that.
Is that okay?
Yep.
I'm not surprising you on money.
Nope. Fine. It's up.
And I want to apologize for
The 10 times
for asking.
you've
for
apologized
asking.
this morning.
Hey, yeah. So this is just scan the QR code. If you're a do-it-yourselfer, you like to prepare your own tax return, and you've been dissatisfied with some of the offerings that you've used in the past, just because there's sort of let me just say they tell you one thing and it turns out to be something totally different. So this
They don't apologize.
they don't apologize for it either.
No.
Yeah, exactly. So this is a all-inclusive single fee solution for you to do your personal tax return. It includes multiple states. If you've got you're trading cryptocurrency, or you've got a small business and you're trying to figure out how to put that on your income tax return, it's all there, all for a single price of $34.99.
Nice.
It's a bargain. It really is. And again, multiple states. So if you work in one state, you live in another state, you have to file 2 income tax returns, all included in that single price. And there's also live through a chat option.
Yeah, you always
live.
bury the lead. This is a big thing.
Yeah. Okay. Yeah. so
Someone
you
there
know-
to help you.
yeah, it's a chat feature, but so you're not visually interacting with somebody, but you are interacting with a human being. It's not just a bot. Let's put it that way. So it's a terrific way to do it. And here's the best part: you set up an account and you start putting your stuff in. They don't charge you anything. They don't ask you for a credit card, nothing. You just put in all your information. Basically, you can prepare the return, take a look at it before you file it, and that's when you pay, before you file the return.
Nice.
You can file it paper or online, and you can't. Basically, you can't get it done for free by avoiding the fee by printing it, because they won't let you print a fileable copy.
Yeah.
before you actually pay.
Well,
So
they're running a
yeah,
business.
they are. Yes. Yeah. But it's so inexpensive that, geez, I don't know why you would try to get away with not paying for it. But
Especially if you get some 1099s, this is the way to go.
yeah,
It's such a big help.
yeah. And you know what? This topic that we're going to discuss today, you might need some help with this one too. So this is all about the no tax on overtime. What we're going to do is we're going to walk through probably one of the most exciting tax changes for working families in years. This presentation is all about helping you to understand how the deduction works, who qualifies, how you can make sure you keep as much of your hard-earned paycheck as possible.
Amen.
So let's jump in. First of all, a little context. The deduction is part of the Working Families Tax Cut Act, signed into law on July 4th, 2025. One of the biggest new benefits is a temporary deduction. I say temporary, specifically for overtime pay. The deduction covers tax years starting in 2025. So this is good for what you're filing your tax return now for 2025. This is effective, right?
Mhm.
And it sunsets in 2028. So not permanent, but it's big.
Yeah.
The goal here is simple: reduce taxable income for millions of hourly workers who put in extra hours. So if you're someone who regularly works overtime, or you manage people who do, this can mean real money staying in your pocket. Let's talk about eligibility first. The deduction applies to overtime governed by Section 7 of the Fair Labor Standards Act. I had to look that up and learned all about the Fair Labor Standards Act, right? So it's a rule that requires employers to pay overtime after 40 hours in a work week. So if you're an hourly employee who earns overtime after hitting 40 hours, you're most likely covered, but not definitely. So you have to be sure that you are covered. A lot of things to consider. And if you're covered by the FLSA, likely you can take the deduction, right? Here's the distinction, though. It's not no taxes on all overtime. It applies only to what they're calling the premium portion,
Right.
meaning the extra amount on top of your regular hourly rate. So we're going to walk through exactly what that means.
The half.
The half, exactly, yeah. So let's break down what counts as qualified overtime for the deduction. If you earn time and a half, as you said, only the half portion, the extra amount above your regular rate, is deductible. So if you normally make $20 an hour and overtime pays $30, that $10 premium is what qualifies.
Mm-hmm.
So if you earn double time, the rules are a little different. Only half of the premium qualifies, Lou.
Okay.
So a lot of people get paid double time because they're working a Sunday or a holiday, right?
These government workers?
No, I don't know. I don't know about that. I'm thinking retail workers who are working Sundays or
Getting double time? Yeah.
right. They're getting double time, right? Contractually paid to them, but unfortunately, you can't deduct the entire premium portion, the double of that amount. You only get half of the extra. So as an example, if you go from $24 an hour to $48 an hour, the premium is $24, and half of that, $12, is deductible.
Right.
So the big idea here is that you're getting a tax break specifically on the extra pay you get because you worked overtime. Like a lot of tax benefits, Lou, this deduction phases out for higher earners. For single filers, the phase out starts at $150,000 of adjusted gross income. For joint filers, it begins at $300,000. So if you're above those thresholds, the deduction shrinks and eventually will disappear.
Making $300,000 on hourly? Is that what's going on?
I'm thinking maybe police,
Okay. Well,
right?
Yeah.
That's 300,000 joint, 150,000 individual,
Okay.
right?
Yeah. So yeah.
So
Cops, teachers.
Maybe.
Nursing.
So every and I'm not an expert on
Right.
every occupation that qualifies, so I don't want to say something here that's wrong. You really need to look into your particular occupation and determine whether or not you qualify for it. Generally speaking, we'll get into that in a second. Your employer will be aware of and
Yep.
let you know if you qualify for the deduction, but that's not always true. We've run into some cases where the employer doesn't know. So here in this particular case, because of the phase out, if your income is close to the limit, you'll want to keep an eye on your AGI during the course of the year and maybe take action to reduce that. And I don't mean not make money, but figure out a way to reduce that income that you're making legitimately, like retirement contributions, for example. Now let's talk about maximums. The maximum deduction in this particular case, it's not unlimited. So for single filers, heads of household, and married filing separately, the maximum deduction is $12,500. For married couples who are filing jointly, the amount doubles to $25,000. And this is also a good moment to note that overtime pay still counts for payroll taxes like Social Security and Medicare. The deduction reduces income tax only, not FICA or Medicare.
Okay.
And so getting back to that maximum $25,000, it doesn't apply individually for a married couple. So if one of the spouses is working a lot of overtime and makes all the overtime, and the other makes zero,
They can
still take the $25,000 deduction,
Nice.
even though that individual is over 12.5. Okay.
Like it.
So that can really make a dent in your tax bill, even though you're still paying for Social Security and Medicare. And I think I actually got ahead of myself a little bit here. The $25,000 deduction, to get the $25,000, you have to file jointly. If you file separately, you're capped at $12,500. So by choosing to file separately, you're actually giving up half the potential tax break. So for most couples, if one or both works overtime, filing jointly is almost always, not always, the smarter choice. Best thing to do is test it. Really, that's the best thing to do. Claiming the deduction, pretty straightforward. Your employer is supposed to be straightforward anyway. Your employer is supposed to report qualified overtime amounts on your W-2. Look for box 14, by the way. And box 14 has a lot of other types of deductions or notations of benefits that you receive. And so you're looking for the one that says premium overtime. Make sure your pay stubs and records match what's being reported on the tax return. The IRS may ask questions if things don't look consistent. You or your tax preparer will use that number to calculate your deduction and subtract it from your AGI if it's on the W-2. However, it's not always going to be on your W-2. Some employers are providing a supplemental document in your W-2 or separately sending it to you so you know that you are a covered employee, and therefore potentially if you earned overtime, you can take the deduction. Bottom line here is keep good documentation, especially if you work varying amounts of overtime throughout the year. And let's see, here are some practical tips to make the most out of this particular deduction. You want to track your overtime.
Mm-hmm.
Know your structure, time and a half versus double time. It affects the deductible amount. So just don't assume that all of your overtime is going to be deductible. You have to do a calculation. Monitor your AGI. This is probably the most important thing. If you're close to the phase out threshold, strategic steps like maybe increasing your retirement contributions, which by the way can't be done now unless you make an IRA contribution, and be careful, that may or may not reduce your AGI for purposes of this. I haven't run into that just yet. Maybe a Ask Jeff question for another day. But your contributions to a 401k, no doubt that would reduce your AGI, but you can't make contributions to a 401k after the end of the tax year. So you have to monitor your AGI if you want to take this full deduction.
Yep.
You're getting close to the maximum. you may want to increase your contributions to the 401k on a pre-tax basis, not the Roth, and make sure that you're doing that before the end of the tax year. You need some time. It has to be, you can't just make contributions to a 401k by writing a check. It has to come out as a deduction from your regular paycheck.
Oh, okay.
And if you're married, file jointly to get the full advantage. That's the only way to get the full $25,000.
Mhm.
And finally, maybe I should have said this first. This is the first thing that you should do. Consider working with a tax professional if your situation is complex, multiple jobs, fluctuating overtime, or high income. And let me just make a point here. I said earlier that we have a solution for doing the tax return yourself. Just because you're doing the tax return yourself doesn't mean that you don't use a professional like myself who can review what you did. I have a client that in fact, they use this particular solution, and every year they send me a copy and say, "How's it look?"
Help. Yeah.
And we found some areas where we could actually save some money. So just because you're doing your tax return yourself doesn't mean that you don't employ
Right.
a financial professional who can help you to understand your situation, maybe come up with ideas to reduce your overall income tax. That's what it's all about, really, is paying the least amount that you possibly can.
Right. Paying only what you have to.
Only way you have to. And there's nothing wrong with that.
No.
Just so to kind of wrap things up here, no tax on overtime deduction, meaningful tax break for millions of workers, especially those who regularly put in extra hours. You can deduct up to $25,000 of qualified overtime premiums from your taxable income between 2025 and 2028 if you are married. Filing jointly, have to be careful. 12.5 if you are single or married, filing separately. And understanding how your overtime is calculated, how your income affects eligibility, and which filing status to choose are all key to maximizing this particular benefit. And it's a temporary opportunity. So
Take advantage.
Well, so if you're an overtime worker, and you are, and you're looking at this passively, that is to say, whenever your employer gives you overtime, okay, great, but maybe you might want to take full advantage of this by asking your employer to work
Okay.
overtime.
Yep.
Even though to work on a Sunday, even though you're not getting the full deduction for that double time rate, you can still take half of it as a deduction. So yeah, why not maximize? What would that? Well, it would depend on your hourly rate, of course, but I don't know how many hours you'd have to put in to save 12.5. Let's say that the premium portion for the average person is $20.
Yep.
Would that be a reasonable expectation?
Yeah.
So how many hours would you have to put in a year to save to take the full deduction of $12,500?
Good question.
Good question, huh?
We don't do show math.
We don't do showman. I thought I could do that quickly in my head, but $12,500. I think that would be like it would have to be at least $500 at $20. If your premium is $20, that would be at least 500 hours at $20.
Yeah.
$20 an hour. So there you go. So 500 hours divided by
52 weeks.
52 weeks. That's 10 hours a week.
Yep.
Right. So if you did 12 hours, there you go.
Yep.
So there's your charge for talking to your employer to your next performance review. Talk about doing some more overtime. Tell me you want
More
to
overtime.
put, tell me you want to put in
an
an extra 12 hours of a week of overtime. I can tell you when I was much younger, I was putting in 60, 70 hours a week. Now that I think of it, probably hasn't changed much in the last
That's got to say.
40 years.
All right, let me ask you a semi-obvious question just to get the point out.
Semi-obvious.
This is federal taxes only.
Federal taxes only.
I'm
as
from
far
the Commonwealth of Massachusetts. They're not giving me a break.
So I don't know of a similar. I don't think so. Massachusetts. I haven't looked at this actually, and it's a great question. So whenever there's some change to the federal tax law, states will either incorporate those changes or say, no, we're not going to do that. And as far as I know, Massachusetts, the Commonwealth of Massachusetts, has not adopted that change.
I'm shocked.
And a lot of these temporary ones they don't buy
Yeah,
into because for
Just
a
messes
lot
things
of
up.
for a lot of reasons. That and they lose their revenue. Don't forget.
Yeah.
All right, so no tax on overtime, temporary benefit, take full advantage. We should probably take a quick break here, Lou, and when we come back, I've got a Ask Jeff question.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005.
The Ask Jeff question. One of my favorite parts of the show, Lou.
Mine too.
Where we get to answer specific questions. A lot of them come from you, I've noticed.
I have a
Why
like
is
mind
that?
with our watchers and our viewers.
So today's Ask Jeff question. We have a second home
Good for you.
and and decided to rent it through Airbnb and VRBO. Verbo, is that the way you pronounce it
I
now?
don't know.
Verbo. Although the total of expenses, I should say that anybody who owns a property that's thinking about renting, they're familiar with that. But those of you who aren't, Airbnb and Verbo, those are apps that you can list your property and rent it. Heard a lot of horror stories about that. So be careful if you're thinking about doing something like that. But although the total of expenses, so they're doing their tax return and they've determined that the total of expenses exceeds the income that they received. They just started renting it, right? So that's easy to do, right? The loss in this case is disallowed because the AGI, adjusted gross income, is too high. What am I missing? So let me just say that the reason why,
You're missing a tax professional. That's what you're missing.
well, yeah, but well, I'm not going to discount the value that can be added here, but for this particular question, I need a little explanation. The AGI that they're referring to is a limit for taking what's known as a passive activity loss.
Okay.
So typically, when you rent property that you own on your personal tax return, then it's considered a passive activity, even though you might actually be actively participating.
Sure. Yeah.
It's considered a passive activity, and there are rules that say that if your AGI exceeds a certain level, then any losses that you incur in that passive activity cannot be taken in the current year. So you can deduct all the expenses up to the amount where it starts to become a loss, and that's it.
Okay.
So you don't have to claim any income, but you don't get to take the loss and apply it to reduce your other taxable income, right? And so, by the way, you carry that over. So it's not lost totally. It gets carried over to another year. So you can use it to offset income that you receive in future years, but never more than the amount of income that you receive. Unless there's an exception. Unless it's you are actively participating in the rental, and it's short-term rentals,
Oh, okay. Yeah.
typically a week or two, or at least less than 30 days at a time.
On average, yeah.
And so you put it, you threw in the on average. I'm not gonna
Okay.
I'm not gonna say
Oh,
you can
yeah,
average
no, I
it.
get it.
I don't want to say that you can
You're
average
right.
it out. Okay.
You're right.
Yeah.
Yep.
So as long as you are actively participating, in other words, you are the one that's meeting with the tenant, with the renter, right?
Right.
With the guest, in this case, the guest. You're meeting with the guest because you're doing this through Airbnb and Vrbo. They're typically, those are short-term rentals anyway.
Mhm.
So you have to just make a distinction between whether or not this is you're renting this year round to somebody. You have a 1 year, 2 year lease versus you're putting it on Airbnb and you're getting whatever you get, and they're all short-term rentals.
Right.
Under those circumstances, you are allowed to take the expenses and if it is a loss, apply it to and reduce other taxable income. Very important.
Yeah.
And if you're using software, you have to make sure that the system understands the type of rental that you have. Otherwise, you're probably not going to get the benefit of that loss. So, using a professional wouldn't hurt in this particular case. But once you know what you're doing, it's something you could probably do every year going forward.
Yeah, but while you're ramping up, especially renting out your home, especially short term, you got to talk to people. Don't just wing it.
Oh yeah. And in some localities, there's restrictions on how much you can rent it, how long those rentals can be, and potentially there is a rooms tax in New Hampshire. I know that there's a rooms tax that you'd have to pay because now you're a hotel. So you have to register with the state and make sure that when you collect the rent, you're doing that. But these systems like Airbnb and Vrbo, they are pretty well versed on these things and will guide you through it. There's that's it. I mean, that was a great question. And I was thinking too, if you're someone who has in the past have been doing this and have not been able to take the deduction but didn't know that there was an exception, you can always go back and modify or amend your tax return for the last 3 years.
Yep. And
maybe claim a refund. So you might have to, if you actually go back more than a year, you probably have to redo every year thereafter. So it could be a lot of work. Something that
could be worth it,
and something if you're not up for it, give us a call. We'd be glad to help you out with that. All right, so that's it for this week. We'll have some more in the future. Remember, in the meantime, good sound advice is much better than advice that just sounds good. Thanks, Lou.
Hi, this is Jeffrey Shank, a chartered financial consultant and the host of the Talk Money Show. I've been helping my clients for more than 30 years, and now I'm going to help you. Join us to learn about the financial issues that concern you the most. You'll hear from the experts on a range of topics, get some great ideas, and it's all designed to help you make more out of your money. So tune in to Talk Money right here on Eagle News Radio.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer, member FINRA SIPC. Investment advisor representative, Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Financial planning services through Andover Advisory Group, a registered investment advisor. Cambridge and Andover Advisory Group are not affiliated. Cambridge does not offer tax or legal advice.
Good morning, Justin. I want to thank you for your hard work. The information is a big help, and I appreciate what you did.
Enjoy the show.
All right. Thank you.
Okay, that's great to know. Thank you for the information.
You're very welcome.
Okay, Jeff.
Okay.
Thank you very much.
You're very welcome.
You're right on the money there, Jeff. How you doing this morning?
Thank you.
Well, those are good questions. Hopefully that helps.
Yes, thank you so much.
You're very welcome.
You're going to hear stuff here that you don't hear anywhere else on radio.
And you don't forget it.
I'm Jeffrey Shank, and this is Talk Money. I'm a chartered financial consultant, owner of Andover Advisory Group, a registered investment advisor, and we have been providing effective financial advice to individuals and families for almost 30 years now. My mission here on Talk Money is to help improve your money IQ. One of the goals that I have is to educate you on the tax code so that you can minimize the total amount of taxes that you have to pay the government, keeping more money for yourself and your family. And so, Lou, if it's okay with you, I do want to start by showing the QR code for people. I want to do that commercial.
Yes, sir.
If you don't mind,
I don't.
That's okay. All right. Yeah.
We're all set.
Oh, it's already up.
Yep.
Okay. All right. Good. Cool. And we'll get to. We got a great topic in that regard. And it's the home office deduction.
Ah,
All right. Yeah. This much misunderstood
imagine.
deduction. So we want to try to clarify things today. But before I get to that, I want to talk about this do-it-yourself tax prep solution that we have. It's all online. You just scan the QR code. You go right to the website. You can start your tax return without giving any credit card information. You don't have to pay for it until you're ready to file. You can basically prepare the whole return before you actually make a payment, and it's very inexpensive. Only $34.99. I don't know why they did it that way, but I'll just call it $35. Could be some tax. In some states, you have to pay tax. I should make you aware of that.
Oh God,
So,
I forgot.
and there's help. There's live help available through a chat arrangement. So you're not actually talking to somebody face to face. Somebody's not doing your tax return for you, but they'll help you through the program if you're having some difficulties. So it's a great solution, and I should mention that it's all in. So it includes federal and state taxes, as many states as you have to file.
Huge, yeah.
It covers if you have investment property, if you have investments, capital gains, you do crypto trading, you're self-employed, you can do a Schedule C. It really is. It's a terrific, all-encompassing solution for those that like to do their tax return and may have been disappointed with other alternatives who claim that you can do it for free, but find out you really don't qualify to do it for free because you happen to have.
Because you live in a state.
You live in a state, right? Yeah, because you live in a state. Exactly. Right. Yeah. Good point. So. That, if you have any questions about that, give me a call. If you're having difficulty or you have some concerns, I'd be glad to talk to you about it. And today we're going to talk about, as I mentioned before, the home office deduction. It's a tax benefit that's available to self-employed individuals. My goal here is to keep this simple, clear, doable. By the end of the session, you should understand whether you qualify, how to calculate the deduction, and how to avoid some of the pitfalls that trip up so many taxpayers. So we'll get right into it. Before anything else, we need to understand who can actually claim this deduction. First, this is a deduction for self-employed individuals. That includes sole proprietors, independent contractors, freelancers, partners in a partnership. Because partners in certain partnerships who aren't being taxed as a corporation, the income, net profits flow to the individual, and because it's earned income, they have to put it on a Schedule C. So employees who get with W-2 employees used to qualify, but that part of the law is suspended for now.
Yeah.
So W-2 workers can't take it, unfortunately. Next, the space that you're using must meet two key requirements. And here they are. Exclusive use, meaning the area is used only for business, not sometimes, not mostly, exclusively. Even occasional personal use can invalidate the deduction. And regular use. In other words, it needs to be part of your ongoing business activities. Not a once in a while workplace. Finally, this office has to be your principal place of business. That doesn't mean you never work anywhere else, but it must be your primary hub or a place where you regularly meet clients or customers. So let's continue here. Talk about the first of the two calculation methods, the regular and also the safe harbor method. The regular method, also known as actual expenses. Here you calculate the business use percentage of your home. So if your home if your home office is 200 square feet, your entire home is 2,000 square feet, that's 10%, right? 200 is 10% of 2,000. You can apply that percentage to a long list of expenses: interest on your mortgage, property taxes, rent, utilities, insurance, repairs, maintenance, and even depreciation on your home. The big upside, this often yields a larger deduction, especially if your home expenses are high. The downside, you have to keep really good records, receipts, utility bills, repair invoices, and the calculation can get a little tedious. And let me just make one point here. Some expenses like utilities, insurance, repairs, real estate taxes, mortgage interest, these are indirect expenses, meaning that you would apply the 10%. But there are cases where you're making improvements to that space alone and can actually be considered direct.
Oh, I see. Yep.
Direct expenses. The second option, as opposed to the actual expense option, is what's known as a safe harbor. Introduced by the IRS, it was created to make things easier, especially for self-employed taxpayers who don't want the headache of tracking every home expense. Makes sense?
Yep.
Who wants to do that? So here's how it works. You measure your office up to a maximum of 300 square feet. That's a pretty big office.
It's a big office, yeah.
20 by 15,
Yeah.
right? You multiply that by $5 per square foot. That's your deduction. No receipts, no depreciation, no tracking utilities, just square footage times 5, with a maximum deduction, obviously, of $1,500. The advantage of this is almost zero record keeping and no depreciation recapture when you sell your house, which I'm going to get into a little bit later.
Oh, boy.
The con, the disadvantage here, it may be much smaller than the regular actual expense method, especially if you have high costs or a large office. So, which method should you choose? Here's something important. You decide each year.
Oh.
So it's not a, hey, once you decide, that's it. The choice is irrevocable for that tax year. So what do we mean? That means if you later on decide to amend your tax return for some reason, you can't choose the different method. So if it turns out, hey, I think I should should have taken the regular method. Once you file that return, whatever you chose, that's it. You can't reverse it.
That
But
choice is not amendable.
right, but you do get to choose every year which
Yeah.
method. So if it turns out, hey, you made a mistake this year, and you should be using the alternative method, you can always make that decision in a following year. So the best way to approach this really is to run a quick comparison. So people with modest home expenses, the safe harbor method might often win because it's simple. But for those with large offices or high utilities, mortgage interest, or property taxes, the regular method can produce a significantly higher deduction. But there are some pitfalls when you ultimately sell your house. Okay. So let's talk about maximizing deduction and protecting it. First, take the exclusive use rule seriously. So what we mean by protecting it, making sure that it meets IRS requirements, right?
Yep.
You want to make sure that it can survive an audit. So if a guest sleeps in your office 3 nights a year, technically the space no longer qualifies. This is your home. You're wondering why somebody would be sleeping in your office. This is your home.
Yeah.
Right. So if you have a guest over and you got a couch there and it pulls out to a bed and they're sleeping there a couple of nights, guess what? You just violated the exclusive use. So the IRS is very strict on this. How are they going to know? Don't ask. I don't know. I don't know.
They just
But,
know.
You know, they might know. Next, track every legitimate expense. That includes utilities, internet, phone, cleaning, supplies, office specific repairs. All of it matters. If you're using the regular method, don't forget depreciation. It can be a substantial tax savings, but remember, it may create future what's called recapture. Again, we're going to talk a little bit more about that. And if you run a licensed daycare business, you get special rules. Actually, you don't need to apply the exclusive use rule.
Right.
So you can use the space where you're running that daycare center for more than just your daycare business. And if you want some more information about that specifically, IRS publication 587
Okay.
will give you the details there. So let's look at what causes the most trouble during an audit. The biggest issue is, as I said before, personal use. If the space is used
Personal use contamination, is that?
yeah, personal use contamination.
All right.
Yes, it contaminates the deduction.
I get you. No,
Okay, doesn't contaminate the space. Don't get me wrong. You can still use the space.
Just an interesting word
Still-
choice. That's all.
Hey, I figured you'd like my word
I
choices.
did.
I think you
like it.
appreciate my
I
word
like it a
choices,
lot.
being the wordsmith that you are.
Yeah.
Okay.
That's why I noted it.
Even if it's used partly for personal activity, the entire deduction can be denied. Poor record keeping. If you don't have receipts, utility statements, or a simple floor plan showing square footage, the IRS can possibly disallow your deduction. I'm not saying they're going to,
Yep.
but possibly disallow your deduction. Another key rule, your deduction cannot exceed your net business income. Very important. So a lot of people, when they start up a business, they have a lot of expenses, and those expenses can exceed their income, especially in the early years of a business, creating a loss. That loss can be used to offset other income, including W-2 income. However, the home office deduction is limited to your profits. So if your profits are less than zero, guess what? The home office deduction is not going to help you. So you can't use it to create or increase a business loss. The excess deduction. Oh, by the way, that's important too. That excess deduction, if you run into that situation, you can't carry it forward.
All right.
So it's lost forever. So if you're starting up the business, yeah, you got to keep track of your home office. Put it on the tax return, but you might realize because your expenses exceeded your income in the early years of your business that it's lost, and it's lost forever. You can't get it back. And finally, and this is very important, if you take depreciation, remember recapture. When you sell, ultimately sell your house. We're talking about home office, right? You sell your home.
Right.
You decide to sell the house. Any depreciation that you've taken previously, whether you could or couldn't, if you were able to take it or were otherwise eligible to take that depreciation, even though it wasn't deducted, it can come back to bite you, because when you sell the house, you have to identify the amount of accumulated depreciation, and it's taxed differently, and as much of a 25% rate. So think about that.
But the depreciation is different from the expenses.
Correct.
Okay.
So you don't have to reclaim, you don't have to identify and recognize gains or taxable income on all the expenses
Right.
that you took or didn't take, right?
Yep.
But any depreciation that you took has to be recognized, accumulated depreciation, not just in the current year, accumulated depreciation.
Yeah.
So if you're taking this home office deduction for the last 20 years and you've been depreciating a portion of the that could add up.
Yep. And
you have to recognize it and pay a separate rate up to a maximum of 25%. So this could bite you in the butt
Yep.
if you're not careful with that. Okay. And it's a good reason to consider using the safe harbor method, right? If you use the regular method, you've likely claimed depreciation over the years. When you sell your home, the IRS, as I said before, is going to require that you recapture that depreciation. If you use the safe harbor method, you avoid depreciation entirely. So there's not a calculation in that safe harbor method
right.
that includes depreciation that you'll ultimately have to recognize. So there's no recapture, no impact on your home sale exclusion, which I should have mentioned before. When you sell your home, you're entitled to, each taxpayer every 2 years is entitled to sell their home as long as they meet the ownership and use tests for at least 24 months out of the last 60. They can exclude up to $250,000 of capital gains. Otherwise, you would have to pay gain. So the home office deduction using the regular method and having depreciation could cut in to that home office exclusion if you were to use it. So the safe harbor method, one reason to use the safe harbor method is to avoid that complicating headache and maximize the exclusion amount when you sell your home. And it still can be significant.
Yeah.
Up to $1,500 as a deduction. If you're in a 20% tax bracket, that's $300 back in your pocket.
Otherwise, if you use the regular method, you can just not take depreciation.
No, whether you took it or you ignored it.
Oh,
Yeah, you still have to consider it. Yes,
so there's not a running total. It's
correct.
oh boy. Okay.
Yes. So if you depreciation that you deducted or were eligible to deduct has to be recaptured when you sell the property, when you sell the house. Yeah. So nope, can't get around it that way, Lo.
Okay.
I like the way you think, though. And the home office deduction gives you a 2-for-1 benefit. It lowers your income tax, right? And it also lowers your self-employment tax,
Right.
15.3%. That double deduction makes it more powerful than many other deductions. I said, $1,500, but you're going to get your tax rate 20% plus another 15% because you're not paying the self-employment tax. And keep in mind, the regular method can be much larger, but comes with record keeping, potential future recapture. Choosing the right method, staying organized, and understanding the long-term implications helps turn this deduction into a genuine financial advantage. So to wrap it up, first of all, and I probably should have mentioned this earlier, consult with a tax professional. Your situation, everyone's situation is unique. Home size, income level, whether you plan to sell your home, all affect the best choice. Second, stay organized year round. Don't, try to figure this out on April 1st. Whether you're doing safe harbor or the regular method, good documentation is always your best friend. And third, run the numbers every single year. Your optimal method can change, so just don't assume 1 year that hey, I took safe harbor and I'm going to keep taking safe harbor, or I've been using the regular method and that's going to make the most sense for me because it made sense 2 years ago. Used properly, the home office deduction is one of the most powerful tools for reducing taxes for a self-employed professional. So again, if you need help on that, need some basics, give me a call. I'd be glad to talk to you about it. Be a good discussion. Bring in your prior tax returns, and we'll take a look at it. It might be an opportunity to amend the tax returns because you did things wrong in the past. You didn't take the deduction at all. That's a possibility.
Yep.
And keep in mind that once you choose either the regular or the safe harbor method, that's irrevocable. So even if you amend the tax return, we can't fix that. All right. So we're going to take a break here, Lou, and I have an Ask Jeff question that I want to get to. So stay tuned. We'll be right back.
Whether you're saving money for your children's education, preparing for retirement, or deciding on the right life insurance plan, you can count on the professionals at Andover Advisory Group. Established in 1996, our company is responsible for providing financial planning services to individuals seeking sound financial advice. We create a comprehensive financial plan that serves as a framework for organizing the pieces of your financial life so that you can focus on your goals and understand what it takes to reach them. And a financial plan can help you prioritize. For example, how saving for college might impact your ability to save for your retirement. Having a clear perspective will allow you to pick the right strategies and confidently choose suitable products and services. Best of all, you'll have the peace of mind that comes from knowing that your financial life is on track. Call us at 978-691-5005 to book your free initial consultation. That's 978-691-5005.
Our Ask Jeff segment. We get a lot of questions on a regular basis. We highlight some of them here on the show, and I was just thinking that we could probably do an hour a week just
Ask Jeff's.
Yeah,
Full Ask Jeff episode.
Just an Ask Jeff, right? An hour a week, and probably never repeat.
Good.
any of the questions.
It'd be good
because we get questions constantly, and I would say that the majority are about income taxes.
Yeah.
Because it's confusing. It's confusing. I'm not saying that they're only about that, but the majority of the questions that come up
confusing and intimidating,
especially this time of year.
Yeah.
Confusing, intimidating.
Yeah. No. But then again, I live in Massachusetts.
That's so the questions I get all the time. So you don't think that this might, raise some red flags? It's a legitimate tax deduction. Why would it raise a red flag? You think we should? A question came up this week. Client, I said, look, you really should. We need to really take our time here and do this right, and not rush to try to file the tax return. So you should just started a new business. So you let's just file an extension, and then you can and then we can we'll estimate what the taxes might be, so you don't get in trouble with the taxing authorities. So we'll send them some money that way, because that's really what they really are mostly concerned about. I mean, they want to see the paperwork, right? But they want the money more than anything else. So send them the money. And then
today's topic, home office and exclusivity. You don't want to contaminate it.
You definitely don't want to contaminate it. Exactly.
It's a legitimate question. It could raise a red flag.
Could raise a red flag if it's contaminated.
Yeah.
They send out the they send out the contamination, the hazmat.
Hazmat?
They send out the hazmat team.
IRS hazmat?
The IRS hazmat team poke around, see if there's any evidence of personal use in your home office.
Because they're not overworked.
What do we got? We got we helped a client request for a charitable organization that they have request a designation as a qualified charity,
Mhm.
right? And it was fun doing, and they got a response from the IRS that said that it might take us up to 3 years to issue the.
Wow.
Seriously.
No, I'm not totally shocked. First of all, the
Yeah.
IRS is underwater, but that's
Because
a
of-
complex process.
because of staffing issues.
Yeah.
That's what you mean. Yeah.
And
So
a big beautiful bill and
so
all the tax games that are being played.
so they said operate as if you are a nonprofit.
Really?
Yeah. So but if you don't, then which means filing tax returns too. So
Right.
they want you to file a tax return that would be due as a qualified charity.
Because you could post disqualify us. I'll post.
If you don't, right?
Yeah,
If you don't
yeah.
file, even though you don't have the official blessing
Operate
from
as if you
from
do.
the
Yeah.
you operate as if you did,
That makes sense.
isn't it?
Yep.
Yeah. Well,
3 years.
makes sense to the IRS. I don't know.
3 years.
Hopefully they won't say, no, you don't qualify. My guess is that they probably do a preliminary
Yeah.
and say, this is probably going to qualify. So we'll just tell them, hold on.
It's
Just operate as if you are, and we'll get it to you
a
eventually.
good guess.
Yeah.
That's all it
Imagine if
is.
they came back and said, "Nah, you
Yeah.
know, what do you do then?" I don't know. Anyway, I don't think that's going to happen in this particular case. So, so our question this week, Lou.
Yep.
I'm self-employed. I use a space in my home strictly for business.
Okay.
So it's the home office deduction. I'm eligible for the home office deduction, and my CPA says I should use the safe harbor method, which is a smaller deduction to avoid taxes on depreciation when I sell the house. We talked about that
Yep.
during that discussion about the home office deduction for self-employed. And yeah, that could make sense, but the regular method could produce a much higher deduction.
Yeah.
So what do you prefer? And how much does it cost to claim that depreciation when you sell the house? Or maybe there's an alternative, Lou.
Oh,
Maybe there's an alternative.
I'm listening.
Don't try this at home. 1031 exchange.
Okay. Explain.
So
please.
you can exchange one piece of real estate that you use in business for business purposes for another piece of real estate that you use for business purposes, and you get to defer any capital gains when you that would ordinarily have been recognized when you sell that first piece of real estate. It's very complex.
Yeah.
Nobody does a swap, so you have to actually employ a third party, an expert. They call it a qualified intermediary, QI, to handle the transaction. Basically, they take possession of both properties for a split second. But that's a
Wow.
topic for another for another show. But you can do that because a portion of your home is a home office.
Yeah.
So you actually have two properties. one that's your personal use, one that's your business use. And if you're exchanging, if you're buying another house to live in, where you're not retired, you're going to
Yeah.
continue to use it, and you're going to continue to have a home office, you could actually potentially a 1031 exchange
Wow.
and avoid the recapture on the depreciation for using it as a deduction for home office.
Wow.
Yeah, neat, huh?
Yeah.
Don't do this at home.
No, don't try this.
Don't try this at home. Get a professional involved. You have to anyway. And a qualified intermediary would have all the information. They wouldn't take on the case and actually handle the transaction
Right.
if they didn't know that you could do this. So,
They're
but that is a
skilled-
possibility.
skilled in this type of transaction.
They are absolutely skilled. Yeah, you have to. Yeah. So hire a professional for that one.
Yep.
Yeah. So that's the Ask Jeff question for today. We'll have, as I said before, we got tons of them. We could just have a.
Let's
You
do
know,
one. Let's just do an Ask Jeff episode.
Oh yeah. Well,
Otherwise
maybe.
known as, do you think this is a good
you
idea?
think this is a good idea? Yeah. All right. So we'll have some more in the future. In the meantime, please remember, good sound advice is much better than advice that just sounds good. Thanks, Lou.